Really, the big story for U.S. equity markets as we head into 2019 is how long can these fundamentals, economic fundamentals, and this earnings growth be sustained? Because if you're a valuation-sensitive investor, or you're concerned about PE ratios or cyclically adjusted PE ratios, the Buffett indicator, if those metrics have been saying stocks are historically expensive for quite some time. So anybody buying stocks at these prices has to be convinced that the US economy has quite a bit of runway left before any type of an economic downturn or recession. And as we move into 2019, the effect of tax cuts will fade and go away. Share buybacks, which are going to reach $1 trillion in 2018, the largest year for share buybacks on record, those are going to begin to fade. And the Fed is continuing to hike interest rates, and they're expected to hike again in December of 2018 and 3 more times next year. So all these factors would suggest economic growth has likely peaked here in mid to late 2018 and is going to slow. And the question is just how rapidly will economic growth slow? Will we settle to a sustainable growth rate of 2.5% to 3%, something we're used to since the global financial crisis? Or has the tremendous amount of debt that U.S. households and U.S. corporations have accumulated, does that ultimately result in a situation where economic growth slows dramatically and you have pain in the corporate sector, you have defaults, you have a classic credit crisis?